Blow-ups, buried bodies, and behavioral biases. Well, now that we have your attention, we are turning to Jon Havice. He is President and Chief Investment Officer of DGV Solutions, here to talk about those very topics, because that's what your panel covered. Thanks so much for coming here.
Thanks. It's great to be here.
So we have to get right down to it. What was this all about?
Yeah, I think what we wanted to talk about was really have a provocative panel where we talked about what's driven the last 10 years post-crisis, and a lot of it's really been driven by central bank activity around the globe. We all know this. They lowered interest rates to zero or below in many cases. They engage in a lot of extraordinary monetary policy, buying assets, quantitative easing, and things like that. And what's happened is we've had a compression of what I call the risk asset accordion, and so but that whole thing, from treasury bonds to investment grade bonds and high yield bonds and getting into option strategies and all these different things that investors are searching for yield has compressed. But it's all resting on this foundation of monetary policy that is really extraordinary, where you have $10 trillion of global bonds that have negative nominal yields, and yet there's still inflation. So locking into those bonds will produce a negative return and a destruction of capital over time.
So what's the outlook for the market then, the stock market?
Yeah, that's a good question. I think the risk is something goes wrong with that weak foundation or that central bank altered reality foundation, and we'll see. We've clipped along for 10 years, but we'll see whether we can keep going.
What would you say is the biggest takeaway from your panel?
Yeah, I think what we wanted to do was also, there's been some talk in the last year about just crowded trades, and a lot of it's been driven by this central bank activity and the behavioral bias as investors continue to seek yield and go out the risk to get adequate returns. And there's been some articles written saying the short volatility trade is really crowded, and so we wanted to add that up. So we went around, we used a lot of different research databases, eVestment and Bloomberg and Morningstar and a number of others, SEC filings. We added up about $81 billion of short option strategy funds, and that sounds like a big number, but when you look in the context of the overall options market, which trades close to $11 trillion per month, it's really a tiny fraction. It's 0.75% by the way we calculated it. And it's an imperfect exercise because we wouldn't capture every financial advisor out there that's doing buy rights for their clients, or every multi-strategy hedge fund that has a short volatility program. But it puts it in context, I think, of where that short volatility trade is. The bigger risk, we think, is the corporate credit market, which is really a short put profile for investors, and that market has exploded. The triple B space in particular has gone up about 4x in the last 10 years in size. So we think there's probably more risk when you talk about the options market at 81 billion, or if it's more than that, it's not a lot more than that, versus the corporate credit market, which is about $7 trillion. It's just dwarfed. So we think that's where the risk in the short volatility trade is.
I have to ask then, will there be a blow up?
Oh, there will be blow-ups. I think the question is, are the idiosyncratic one-offs like a General Electric or a PG&E or Kraft Heinz, or is it something that triggers a more broad-based sell-off? If there was a recession or a really bad trade war or something like that, then I think it gets more broadly spread.
Well, your panel is very much appreciated. Thank you so much for coming to RMC.
Thanks for having me.